Last week, we talked about everything that Dave Ramsey gets completely wrong about cash value life insurance. It was a great episode. If you haven't heard it yet, go check it out. This week, we are going to talk modified endowment contracts, aka MECs. MEC limits, how are they calculated? What is a MEC? How do you avoid it? Everything you need to know about the MEC limits for whole life and IULs, we're going to talk about right here in this episode. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
This is Jean with Tech Zen Millionaire Club.
And my name is Carlo Vaquero with NetWealth Finance.
All right, MEC limits. MEC stands for Modified Endowment Contract. They're calculated differently between whole life and IUL, and those are the two specific ones we're going to deal with. But all cash value has some type of a limit on how much money you can put into the policy, and that's called the MEC limit. Term insurance doesn't have this because there's no cash value component. So first of all, why do we have MEC limits on life insurance? Carlo?
Well, one of the big things that happened, it was, I think, in the 70s and 80s, that people kind of discovered that you could really use this life insurance as a tax shelter. And people were paying for very, very minimal amounts of insurance and effectively being able to have almost no costs inside of their policy and put in millions of dollars into a policy and have all of that tax-free gains available for use during their lifetime. And it was really a beautiful tax shelter. People took advantage of the system. And so in response to that, the IRS and the government came up with ways to protect against people taking advantage and creating a tax shelter through life insurance.
And Jing, tell us a little bit about MEC limits. What happened when the IRS figured out, these people aren't really using a tax shelter. They're doing tax avoidance, and they didn't like that very much.
All life insurance fall into IRC code 7702. Basically, the life insurance policy death benefit will be tax-free. And because whole life or IUL, it has cash value, it's tax deferred. So for people overfund their life insurance policies, it could become modified endowment contract. It will lose some of the tax benefits for the cash value if you withdraw, but the death benefit is still passed down tax-free.
Within a MEC policy, the death benefit does still transfer tax-free, but where you lose in a MEC is some of those things that we like to talk about in borrowing against our policies, and the treatment of it becomes a last in, first out tax treatment. So when you borrow against or access your policy, you are accessing the gains first. And that's why you lose that tax advantage treatment in that life insurance.
Yeah, there's a number of different penalties that may come about in relation to life insurance versus the modified endowment contract. So some of those changes, you mentioned one of them is it switches from a first in, first out basis when you do withdrawals. What other kind of effects does it have?
Another impact is if you withdraw a modified endowment contract policy, you will face 10% penalty if your age is before 59 and a half.
Yeah, it gets treated like a retirement account, essentially. So you still end up paying taxes and you get the penalty as if you were withdrawing from a retirement account prior to age 59 and a half. What else?
Yes, and I think a big one is you're subject to these things even if you're trying to borrow against your policy. So this is really where it destroys the power of the MEC to be used in how we want to use our policies. And if we're talking about infinite banking, or as I call it, NetWealth Finance, we need to be able to borrow against our policies. So it's just not advantageous to use a MEC for these purposes. And in a lot of ways, you lose a lot of what we want to do for funding business ventures or whatever we might want to do with our life insurance policies.
So just to be clear, that's because the loan gets treated like a withdrawal if it's a modified endowment contract, and you're going to get those same penalties and pay the taxes.
Another information needs to be mentioned is once a MEC, it's always a MEC. That's why when your policy will become a MEC, the carrier actually will notify you if you overfund the policy will become a MEC. So that's something we need to pay attention. If your intention is not only for the death benefit, you want to borrow against the cash value, that's really something you need to pay attention to.
All right, so we talked about all the bad things that happen to your life insurance policy or how it gets treated differently if it becomes a MEC. What determines the MEC limit? There's two tests out there that determine a MEC limit. Since we mostly deal with whole life and IUL for our high cash value purposes here on this channel and the things that we're educating around, let's talk about those two and the MEC tests available with those products. What MEC test gets used when we're purchasing a whole life policy?
So with a whole life policy, it's the cash value accumulation test, or we might say the CVAT test. And that's the only one that's available for whole life. You don't have the flexibility to choose. And that is one of the reasons why sometimes in many whole life carriers and policies, it might be harder to fund for a very long time. There are some that have that ability to fund and use different mechanisms to increase your funding time.
And the IUL, what does that one offer for MEC tests? Jane?
For IUL policies, we'll have the choice to choose between the CVAC as well as the guideline premium test.
Yeah, the guideline premium test is the other type of MEC test. And when you first start your policy with an IUL, you can choose which one you would like to count for your MEC test. They are calculated differently, but funny enough, the CVAT test will ultimately dictate the amount of money that you can put in over the first 7 years of the IUL policy, especially when you get older and the CVAT amount happens to be a lower number than the guideline premium test. The first 7 years, the limit is going to be dictated by that limit of the CVAT test. And then after those 7 years, if you chose the guideline premium test as your method of choice, then that higher level kicks in that it offers.
One of the reasons why we prefer the guideline premium test for IUL products is we actually have access to an overloan protection rider when we do not trigger, when we use the guideline premium test. And there's a number of products that only offer that when we use that guideline premium test. So one of the ways that the guideline premium test is also advantaged is if we use the increasing death benefit, then we can actually put in more money over the life of that policy, and we can fund for a very long time. And that's really where it comes to be the advantage for using these products as a banking policy, as a financing policy. So that's one of the reasons why I think guideline premium is great for a number of different products.
So one thing that's critical that people need to know is how the MEC limits are affected. What are the determining factors that the IRS decides that you can put in less or more money into any particular policy?
It is determined by the death benefit, age, health rating, and sex. So we'll determine what's the limit for that MEC.
Yeah, the younger you are, the lower the MEC limit is going to be for a particular policy because you have so many years to fund a policy. Alternatively, if your health isn't so good, they figure you're not going to live as long, so you need to be able to put more money in a shorter period of time. So you're going to have a higher MEC limit if you have a lower health rating. So an easy way to think about this is the longer you think you're going to live from when you're buying that policy, the lower the limits on how much cash you're going to be able to get into it. So now that we know the reasons that you might not want a MEC because of all the potential consequences, and we know what goes into determining the MEC, what are the specific things that we do when we try to design a high cash value whole life insurance policy in order to increase that MEC limit and have the ability to overfund and turn into a lot of cash.
One of the biggest tools we have in our toolkit for doing that is using some kind of term blend. Different carriers will have different ratios that you can do this and different ways that you can do this, but we blend some term insurance with that base whole life policy in order to more cheaply increase that MEC limit. And that is really how you minimize the costs, yet still have the ability to put in a lot of cash. And it allows for you to purchase more paid up additions and in turn create more cash value inside of that policy.
So the way I like to talk about this with my clients is the IRS doesn't tell us how we get to a particular death benefit and what determines that MEC limit. So in the case of whole life is the most expensive insurance that you can buy at the base level. Well, rather than paying for 100% of a base whole life policy, which is not a good high cash value design, we may end up paying for 10% of the death benefit as whole life. That reduces the whole life expense down to 10% of the policy. And then we're going to blend in the other 9/10 with term insurance. And that term insurance is so inexpensive that it might only add a fraction of the cost in that base whole life as our base expenses. But the MEC limit stays the same as if we bought that entire death benefit as whole life. So you can dump a ton of money into that policy, but instead of having the expenses of what would be 100% base policy, we only have the expense of a little bit more than a 10% cost of that. So it's a massive reduction in expenses, leads to really high cash growth. As far as the IUL now, how do we specially design the IUL in order to max fund this policy but minimize those expenses? Jing?
For IUL, we can do something similar, but it's the blend of the regular base premium policy plus a term insurance. It's very similar to the PUA, the paid up addition. Different IUL carriers will allow you to blend in different ratios of the term policies. So the underlying principle will be very similar, but the terminology we're using here is a little different.
Yeah, that's right. And we also utilize that increasing death benefit in order to bump up the MEC limit. There's a big difference between the MEC limit on a level death benefit policy and an increasing death benefit policy when we're using that guideline premium test. And the difference is almost 3 times as much when we flip it to an increasing death benefit. Now, the key to this, we keep it that increasing death benefit as long as the client is funding the policy. And then once they're done funding it, we're going to switch that death benefit type to level and reduce it to the guideline minimum. That's an important key to do in order to minimize the expenses in this policy, certainly before we get into our 70s, late 70s and 80s, where that cost of insurance is going to start to get more expensive. That's the key to managing your policy in the future with an IUL to keep those expenses down and maximize that cash value.
One thing that you want to keep in mind, if you're going to make this move, it is something that you have to actively do. You have to choose to do this. And it should be when, like James said, you're ready to stop funding. So you can't just switch back and forth. In order to continue to fund, you will cut off your ability to fund MEC space that you might have had. So this is something when you are ready to retire, that's commonly where you might do this. But at the same time, you might do this when you're still young and you just don't want to fund that particular policy anymore.
All right, this part is going to get a little bit into the weeds, but it has to do with what we're talking about right now. When you make a change to the policy, a material change is either you change the death benefit type or you change the death benefit amount. Whether it goes up or down, the MEC limits are going to get recalculated. Normally, we do this when we're done funding the policy, because if you have a max funded policy and you make a change to the policy, they're going to start over from the very beginning of when you owned that policy, and they're going to apply a new 7-pay MEC test on it. It's that test that's normally associated with the cash value accumulation test, but they apply it to every policy. With the guideline premium test, though, we can ignore that after 7 years. But when you make a material change to the policy, it goes back to the beginning. They're going to look at how much money you put into it, and they're going to apply it to that new death benefit that you have. And that will determine if you have any space to put new money in. Well, if you've been max funding that policy, you have no space, at least for the next 7 years. So essentially, just assume if you make a material change in your policy, your MEC limit is going to go to 0. Just don't plan on funding it. 7 years is a long time to have to wait again. You may eventually be able to add some funds again, but it's so far into the future, most people will probably forget it by then. All right, final topic for this one. What happens if it becomes a MEC?
You should receive notification from your carrier that you have triggered a MEC, and they can allow for you to choose what to do to prevent that. And generally speaking, you have the ability to stop it from actually happening. So you will want to keep an eye out for this, especially if you made a big payment and maybe you weren't sure. You want to make sure you're kind of tracking things so that you can prevent that MEC from actually taking effect. And there's a little bit of a grace period for that, for you to be able to do that.
Yeah, technically you have 60 days to correct the MEC. It might be 65 days. It's 60 or 65 days to correct the MEC. How do you correct a MEC policy within that time frame?
So really what you got to do is you got to take that premium back out, any of that excess that would cause that MEC. So you'll take that premium out, and that will allow for it to not trigger that MEC.
Yeah, a good recommendation is to just double check every time you make extra payments. Double check within the next 60 days that it doesn't indicate that it became a modified endowment contract. You'll save yourself a lot of headache. Also, it can be a good idea to check at each anniversary. Just double check. I have had a situation where a client sent in their next year's payment a little bit early, and the insurance company didn't quite catch it, and it applied the amount to the prior year, creating a MEC. Mistakes can happen, folks. Don't rely on the insurance company notifying you. Even though they generally do a pretty good job of notifying you, things can happen. Make sure you protect yourself. I think that about wraps it up for modified endowment contracts. If there was anything that we missed or you have an outstanding question, reach out to us, let us know. Or if you're watching this on YouTube, you can put questions in the comments. We answer every comment that comes through. With that said, do you guys have a call to action for our listeners this week? It's time for this week's call to action.
Since we are in the topic of MEC, I will really encourage our audience to go back to your policy and make sure if your intention is to utilize the IBC, which we're talking about, make sure your policy will not be a MEC. We talk about all the cons of modified endowment policy. So make sure your policies are not MEC policies.
In all honesty, if you're uncertain about these things, you don't have to worry too much. Get in touch with one of us. Even if you're working with a different agent, we can talk to you more about these things in detail. One other thing that I do want to say that's more of a broad thing is we are currently also publishing Substack. If you could follow us there, and we'll be putting out more content alongside of our video content. And it's a good platform for staying in touch with us as well. You can message us or comment on our content on Substack.
All right, my call to action is a little bit different here. My suggestion is if you own a high cash value policy or a cash value policy in general, you're already paying for the expenses of owning that policy. You might as well take advantage of it as much as the IRS will let you and fund it to the highest amount possible. That's right up to that MEC limit. So you can reach out to your insurance agent, have them let you know how much space is available inside that policy for you to add extra funds. You may be able to just reach directly out to the carrier as well, but your agent should be able to get those numbers figured out. I max fund all of my policies to the extent that my funds will allow, but essentially it's a top priority every single year for me to make sure that I'm utilizing every penny of MEC space that the government allows me to. And with that said, I hope you join us again next week where we're going to be talking about infinite banking. How does the Be Your Own Banker strategy actually work? Appreciate you joining us. My name is James Barber. I'm your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
My name's Jean, your host at Tax Exempt Millionaire Club. I'm also licensed in multiple states. Happy to have a chat with you.
And my name is Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with clients across the country as well.
I appreciate you joining us. See you next time.
Thank you.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.